Welcome to Rebank, your front row seat to the future of finance. Matt Homer, welcome to Rebank.
Glad to be here, Will.
Great to connect with you. You're one of the most thoughtful guys in this space. Certainly one of the smartest that I get to interact with on a day-to-day basis. So very excited to have this conversation.
Yeah, it's an honor to be here, and you're too kind, and very excited about what you're building, and it's been really fun to be a thought partner to you in that. And there's a lot to discuss. I mean, a lot happening in this space.
I can share a few lines of introduction about you. You're focused on investing as a venture capitalist, broadly speaking, in the stablecoin and stablecoin infrastructure space. You have an incredible background as a first in policy. I know you're with NYDFS for a period of time. You've worked inside Nyca, an incredible fintech-focused venture capital firm. You're on the board of Gemini, on the board of a company called Standard Custody, which was acquired by Ripple, which you're very close with now. So rather than me continuing to list off your accolades, let's hear it from you. How would you describe your work and your focus areas in this space?
Yeah, I mean, I ask myself that question sometimes too. But look, I mean, I kind of entered my career around the time of Dodd-Frank, right? And so everything was sort of changing. I think those catalyst moments can be so powerful, especially for a career. And I kind of fell into this space. I mean, like I was, went to graduate school wanting to be a diplomat, and then ended up in financial regulation because that was like the big problem to solve, right, at that point in time. And so I felt like sort of, excited to be a part of improving the world around that. So ended up, my whole career has been at the intersection of fintech regulation and finance. Twice a regulator. FDIC, federal regulator, and then New York State, where I was appointed to stand up a new office in the New York State regulator that licensed and oversaw a lot of the biggest crypto firms in the United States. And then have been a fintech
operator. You were actually a regulator in both of those capacities?
Yeah. I mean, I was not an examiner, but I was sort of in between policy and examination. And we can kind of get into how the sausage is made. New York DFS, I was overseeing like the whole operation, right, as it relates to digital asset firms. And then at the FDIC was called the examination policy, actually. So sort of translating, the way regulation works is you got a law and then you write a rule around that law. And then that rule has to be translated into, instructions for examiners, basically like examination manuals. So I sort of sat in that part of the process of informing, developing a point of view on what, things happening in the world meant to the agency, but then also translating this was Dodd-Frank in this instance, right? But translating kind of those laws into rules and then into guidance for examiners or examination procedures is relevant now because, we're starting to go through a similar process related to the Genius Act, right? And so I suspect crypto Twitter and a lot of people in this space will soon become, or think there are experts on how rulemaking processes work.
All right, so I interrupted you. That was
FDIC no, that's good.
And
then spent some time inside of fintechs too. I had the fortune of working for a company my friend started called Quavo, which was a competitor to Plaid.
Pre-acquisition.
Yeah,
it was basically a Plaid style company, but focused on the asset management or investment space.
That's where it started. Yeah, I mean, both Plaid and Quavo kind of started in different places, but then both discovered that kind of this underlying piping they had built, right, for data was the most valuable part of their businesses, and so ended up sort of becoming competitors. I mean, really very direct competitors. I remember we were acquired by Plaid. Everyone is kind of like shocking, right? Because these are like the guys that whatever, like they were the other team, and then we became one team. But both are, Plaid's an incredible company, obviously, and one that I continue to draw inspiration from as I make investments. Yeah, look, the origin of the venture department really comes from my most recent role. I when I left my regulatory job in New York, I joined Nyca Partners as an executive in residence, and those roles can mean a lot of different things. In this context, I was kind of given a really, I wouldn't say free rein, but a wide latitude to do a number of things in the digital asset space and help the firm develop their investment strategy and then to make investments, and made probably around a dozen investments while I was there. And the very first investment actually was Zero Hash, which I think most listeners will be familiar with. And, Edward there made a very strong impression on me. And I remember I asked him, when we were completing the investment, I was like, Edward, why do you want us on the cap table? Like, what are you looking for from us? And he kind of paused to kind of gather himself a little bit or whatever, or form his thoughts. And then he looked at me and over Zoom, like we are now. And, and he was like, it's like, Matt, it's not complicated. I want former regulators on the cap table. And that became sort of the genesis of the idea for the venture department, where I sort of realized that, this kind of unusual background I had of being a regulator, former regulator, working in an investment context, was actually a pretty significant asset in a number of different ways, but including kind of gaining access to the very promising cap tables. I think that we've now done 19 deals out of the fund. And in my experience, the strongest founders in the space tend to be pretty thoughtful about their cap table, actually, right? They're very intentional about how they construct it and who they want on it. And a lot of founders want to have regulatory expertise reflected somewhere on that cap table, right? Or at least it's a nice to have, right? If they can find it, they want it. So that's the lane that we've tried to own. I think we've done a pretty good job so far, and have been had the opportunity to invest in some really great companies like Bridge, and companies that are going to do even better than Bridge, like Multi-Liquid, right? So anyway, but it's been really exciting so far, and of course the landscape has shifted completely since I started the fund. And it's the things that we're investing in, which were not obvious or not consensus at the time, are now things that everyone else is excited about too. So it's a little bit disorienting at times.
So when Nyca, incredible firm. I think of them as a broadly fintech focused firm, a great pedigree. When you joined Nyca, so this was a while ago. People talk about digital asset OGs, but it's hard to imagine someone who's more of an OG than the guy who was overseeing the kind of NYDFS regulatory process for digital asset firms. When would this have been? 10 years ago or something. So when you came into Nyca, how was your perspective on things? I guess different maybe than the house view, and also, what was the dynamic like with respect to how you were thinking about things and how the rest of the firm was?
Yeah, well, Nyca is a fantastic place. I still have a close relationship as I remain an operating partner with them there, in addition to being managing my own fund. And there's a few things that are really unique about them. One is that a lot of their capital actually is from the banking sector, right? And so they've built out a really unique model where they serve as a bridge between founders and the financial system, the banking system. And then they also have this other model, which I kind of adapted or modified and took, or stole from my own fund, which is limited partner advisors. So these are individuals, very prominent individuals in the case of Nyca, who are LPs in the fund and then also serve as advisors to portfolio companies. And they've got a strong network of former banking executives and other leaders. And then we've done the same, but kind of focused more on the digital asset space, and former regulators, also a really great set of folks, want to share their insights with founders. So, I'd say at the time, right? FTX it was actually kind of before FTX collapsed, right? So people were generally kind of curious again, right? It's sort of interesting because it's kind of where we are again right now, right? Just in general with the market, right? People were kind of like, what's a wallet? I should try a wallet. Maybe I should stake some money, right? And people were kind of experimenting. And then FTX happened, and sort of, a lot of people just generally in the market, right, sort of lost interest. I think what's so different about the moment we're in now is that what's been driving a lot of the momentum this cycle has been I would argue kind of institutional actually, right? If you look at like even during the winter, right? You look at BlackRock was investing, BNY was investing. You had like a lot of these top firms were sort of continuing to quietly invest in R&D around this category. And now we have, of course, Genius, which is the law of the land, and stablecoins are legitimized, in kind of the maximum way possible. So I think that this moment feels like maybe crypto has sort of turned a corner in terms of being driven less by speculative craze and more by, I hate to use the word real world or whatever because it's so overused, but sort of, institutional adoption and things that have more fundamentals associated with them.
Yeah. Well, I look forward to unpacking that and also getting into Genius. But I wondered if maybe as a kind of transition to that point, you could tell us a story. So I understand that your first investment out of your fund, right? Like basically your first investment as a solo GP was in Bridge, which was almost immediately thereafter acquired by Stripe. I think I even heard you say one time so quickly that it created some administrative complexity for you. Tell us about that. I mean, what was your thesis in investing in Bridge? Tell us how that came about, and then maybe from there we can take it into kind of what the takeaways are as we've watched the space evolve from there. But take us back to that initial investment.
No, for sure. Yeah, and we have a little blog post on the website that was modified from the investment memo, which I wrote at the time. It's not like I wrote it up like now or something. It was written at the time and kind of reflects the thinking at the time. But well, look, I'd been a DFS previously, right? DFS is the first regulator actually to have rules for digital assets, as well as the first regulator to have guidelines and framework for stablecoins. And so I'd become familiar with stablecoins through the products that their licensed entities were issuing, such as Paxos, and instinctively kind of saw the benefit of those products. And with Bridge, I think the thesis was, it was a few things. It was sort of, conviction in the long term. I already sort of had conviction in stablecoins, right? I already had conviction that like it was here to stay, which to me seemed obvious, but I guess it's like at the time was not obvious, right? Because most people probably wouldn't have agreed with that. And then, another big part of the thesis was about Zach, right? And I think about kind of a lot of the founders I've invested in, it's founders who can bridge different worlds, right? And it's probably because that's like my background, like bridging regulation to investing, or whatever. That's kind of, so I kind of have an eye for that, or an interest in it. And with Zach, I mean, here's someone who had worked at, I may get the pedigree a little wrong here, but I think Square, Stripe, no, that's not Stripe, but Square and Coinbase, maybe one or two other places, and had been in roles where he had worked in more traditional fintech and had also worked in crypto, and pretty meaningful roles. The thesis was that this is the type of profile that is going to bring stablecoins to the masses, right? The pitch also at the very beginning, right, was all about interoperability. It was like, you've got many different types of stablecoins, and eventually it's going to be abstracted, right? People are just going to be interfacing with digital dollars, and under the hood, right, there'll be different stablecoins that are just fungible. So that kind of made intuitive sense, especially I think having been a regulator, we kind of have a bird's eye view on the market, right? And you're kind of looking at some of the structural aspects of it. So that was really the thesis. And then kind of I committed before the fund had even had a closing. So Zach was very generous and said, look, Matt, we don't need the money right away. Why don't you, we can have a handshake or sign something or whatever, but then just wire when you do the closing. So that was it. But it's funny because at the time I talked about Bridge, of course, with investors while we were raising Fund One. And, it honestly didn't make a big difference. I mean, it just shows you how much things have changed, but also how much kind of people are really influenced by kind of macro environment. And as much as humans, we want to think that we're non-consensus thinkers or whatever, or independent thinkers, it's not really the case, right? I mean, FTX had just collapsed, and I'm walking around to investors. I look at this great deal. I got our first deal. It's coming out called Bridge. Isn't it fantastic? Yeah, sure, Matt, whatever, but like I'm not investing in crypto right now.
This is obviously
That-
pre the Stripe acquisition.
yeah,
And
this is before that,
how
really.
quickly did that change after the Stripe
Yeah, I mean,
acquisition?
after the Stripe acquisition, I think those who did invest in the fund, LPs who did, I think were pretty happy with it, and they were able to
Yeah.
call their friends and say, "Hey, did you have any exposure to Bridge? Because we did." So I think I think that got a lot of calls after, right, from
Mhm.
people who, people who maybe passed, but still felt like they wanted to congratulate us and the Bridge team. So,
Yeah.
but yeah, there's
So
a huge catapult,
that's
obviously, for us and the sector.
yeah. That Stripe acquisition of Bridge is, in my mind, one of three, I think, watersheds that I can point to, watershed moments I can point to over the past, probably 18 months, 2 years, with respect to, call it like mainstream or institutional adoption of digital assets. One being BlackRock's launch of their BUIDL fund in, I think it was April 2024. Wow, it feels like ages ago. It was a year and a half ago. Then the announcement of the Stripe acquisition of Bridge, and suddenly, so I guess the BlackRock announcement basically sent messages out to all of TradFi Asset Management that this was a real thing. And I think we've seen firms who were basically set in motion then, even today, starting to launch products. And there are a few firms I can think of right now who are on the verge of launching tokenized asset products that have been working on them effectively since then. So the second watershed then was the Bridge acquisition by Stripe, and that just kind of awakened all of fintech, like Web 2 fintech, payments companies, everyone who previously viewed their work as being kind of outside of crypto or kind of unrelated to blockchain or new payment rails or new financial market rails, and suddenly everyone was on high alert. There was a kind of a one-day conference, just incredibly well timed. Actually, that's how you and I first got connected. Io, former product lead at Cash App, and I think Carbon Health, and now has a fund of his own, was one of the co-organizers of that one-day stablecoin event in SF. It must have been early this year, and it was basically an entire venue full of fintech investors and operators who were kind of realizing that they'd been caught flat-footed by what had been happening in stablecoins when they woke up to the Stripe news. And then the third was Genius. And we'll see if a fourth ends up being market structure. I think
There's one that was before all this, Will, which is I have to mention because I was a part of it. Is PayPal entering crypto? I don't think. I mean, it's at the time, right? It was like a huge deal. I mean, all of a sudden, I think 100 million Americans woke up one morning and they could go and buy Bitcoin, right? Right in their PayPal wallet. And it was my team at DFS that processed that application. But yeah, I mean, you're right. I mean, I think so. I think that may have actually been like one of the starting points, but we've continued to have a lot of momentum since.
Yeah, interesting. Good point. So that brings us around to Genius. So it certainly has been the subject of a lot of yours and my conversations over the past many months at this point. I think it'd be really interesting to hear from you, I guess, kind of like, to your point from before about how regulation is implemented, kind of, where you think we are in that process and how things are likely to unfold, or at the very least, what people should be thinking about over the coming months as they do. So one of the most important things that Genius validated or confirmed, and ultimately, it seems like, at least for the time being, enshrined, is that stablecoins, or at least payment stablecoins, as they're defined under Genius, are a distinct class of financial instrument, which are very similar to cash or to money, in the sense that they are permissionless on secondary. You don't have to KYC every single holder of a stablecoin once it's in circulation, but you do, similar to say a bank account, have to take certain precautions when you're onboarding a primary minter and redeemer of stablecoins. And also, obviously, at least to our audience, inherent in Genius is a prohibition on the payment of yield to the holders of stablecoins. And I hate to say it's an open question because it's not. It's clearly defined in the bill, but it's certainly a topic of ongoing conversation. And I think implementation will definitely be key there. But, just to round it out, what one of the things Genius does is clarifies what is a stablecoin and what isn't a stablecoin, and makes it clear that I think some of the thinking maybe at some point along the stablecoin evolution around this is a kind of replacement for cash, which is also yield bearing and basically replaces a whole class of financial assets across cash and cash equivalents, probably is not the way that the market structure will be implemented, at least in the immediate term. And that opens a whole bunch of kind of downstream implications, many of which we think about all the time at Multi-Liquid. But maybe to kind of pause and take a breath and hand it over to you. How do you think about where we are in the implementation roadmap of Genius?
I mean, first of all, I think like it's we have to recognize kind of just how impactful I think it will be, right, in terms of legitimizing this sector. Stablecoins already existed, right? I would argue they were already legal, through regulatory regimes like New York, but they were inconsistent standards, of course, right, in different states or different, some states that have nothing, some states that have something, right? So the federal law, I mean, is significant in creating a national standard. Right. But also it just gives more categories of users permission, right, to participate in that space. If you're a bank, if you're a large corporate, right, beforehand, maybe you're kind of just sitting a little bit on the sidelines, right, and your R&D or, innovation team was thinking about it. Now that's not the case. Now, if you're a bank, you got to have a stablecoin strategy. Maybe your strategy is that you're not going to participate for whatever X, Y, or Z reason, but like you need to at least think about it. And if you're not going to participate, you have to have a reason for why you're not, right? And I'd argue it's the same for any large financial institution and eventually for any corporate as well. So where are we? So it passed, right? It passed the Congress, is signed into law by the president, and now goes through a rulemaking process. And the way that a rulemaking process works is that there will be sometimes an announced advance notice of proposed rulemaking, which has been issued. And I don't think it's got a lot of attention, but folks should take a look at it. It was published in the Federal Register, which is probably not something that most listeners have spent a lot of time reading. But the Federal Register is where all kind of official federal business is published. And it was published there on September 19th. And what an advance notice of proposed rulemaking does is that it says, hey, we're going to do rulemaking, right? Or we're thinking about rulemaking. In this case, they're going to do it because Congress kind of requires it, right? And they ask a ton of questions, and the questions are super interesting. I mean, won't get into all of them, but it's some things that really matter to the industry. It asks about the yield question, right? And because there's a lot of nuance, right? And the legislation is pretty clear, but there's nuance around how you define certain terms or things like that. So, a lot of interesting questions are raised there, even foreign reciprocity, right, of other countries if they have a similar regulatory framework. What does interoperability mean, right? Because there's a requirement for interoperability in the legislation. I think people should take a look at it. There's 58 questions, and they really do read the responses. I was one of those people that read the responses, right? So that's step one, as an advance notice of proposed rulemaking. Then it'll be an NPR, notice of proposed rulemaking, which will be a little bit more detailed. And then there's a proposed rule, right? And in each of these instances, there will be a period of time for comment. So I think that the current one, let me look here. I think the comments are due, I want to say October 20th. But people often, you'll have 30 to 60 days, sometimes longer, to provide comment. This is really important because this is the proper way of developing rules, and then rules become sticky and sort of hard to undo when they've gone through the proper process, when they've had public comment. It's not just the public commenting, the agencies have to respond and say how they've adopted or chosen not to adopt certain comments. And so they had to think deeply about it. They had to think about like, okay, if we're not going to take this comment, we have to justify to the public why we haven't done it. Right. So that's the process. And then you have the proposed rule and then the final rule. And in this instance, the rulemaking is joint. I mean, there's a number of regulatory agencies that are involved in the process. And this will take, they could do it potentially really quickly. I mean, but really quickly is probably like still a year or something like that. But it will be, a little while. I don't remember the exact dates, but I want to say that 26 is when it's likely to become fully enacted. So that's where we're at in the process. And there's anytime there's regulatory change, legislative change, it creates opportunities for founders. And so I think that it is worth kind of watching it closely and seeing kind of how the market structure could change in response to the rulemaking. Just as an example, right? I mean, there's a question in there about cash and cash equivalents, and should non-Genius compliant stablecoins be considered cash or cash equivalents, and under what situations or circumstances?
Non-Genius compliant or Genius compliant?
Non-Genius compliant.
Oh, interesting.
Yeah.
And question I ask myself is, should Genius compliant stablecoins be considered such? And
if they're asking should non-Genius be considered, then there's sort of a presumption that Genius ones are, right? But then there's the accounting people that set all the accounting standards.
Exactly. There's accounting. There's capital for a regulated financial institution, and then there's also this question in my mind, right? So if a Genius compliant stablecoin is effectively tokenized cash or deemed to be a cash equivalent, is it eligible reserve collateral for other Genius compliant stablecoins? Seems to me like it should be.
Right.
Yeah.
You could have Genius compliant collateral, but then the stablecoin itself is not Genius compliant because to be Genius compliant, it has to be issued by an entity itself. So there's two layers of it, right? There's the entity itself, which is authorized under Genius, and then there's the asset that they issue, which also has to conform with the requirements. So I see a lot of pitch decks, obviously, and a lot of people, I'm sure you see all this too, like a lot of people talking about their stablecoin being Genius compliant or the assets being Genius compliant, but it's sort of like to be Genius compliant, you kind of have to do both, right? You've got the issuer and the asset itself both have to be.
So to the point around state versus federal, you spent time at both a federal regulator and a state regulator. How do you think about that question? I think it's, frankly, for a layman like myself, I kind of see, it seems like below 10 billion in circulation, state regulation, that's probably lighter touch. Above $10 billion federal regulation, that's probably a much heavier touch. But if you're growing a big business, there's only one way to go. But there's clearly more nuance to it than that. How do you think about it?
Yeah, well, and I'll try to be a little concise because you could go kind of deep enough. But just by way of context, right? The U.S. system is sort of, there's some other places in the world that are somewhat similar, but it's kind of unique in that you have a federal regulatory system, a state regulatory system, and they're in some regards sort of co-equal, right? Unless and until the federal government decides to preempt, right? So the idea is anything the federal government has decided to regulate, they have kind of supremacy there. And then anything that's not, right, then the state, it automatically goes to the states, right? So unless the federal government has explicitly said through Congress, we're regulating this, it's up to the states, right? And so crypto's kind of been in that zone, right, during the first, the last at least 10 years, maybe 10 to 15 years, right, of being kind of in the state zone. It's changing quickly. Genius, to some extent, preserved how things work in banking. So in banking, you have two options for a bank charter. You get a bank charter from a federal regulator, the OCC, or you get a federal charter from a state regulator, and you can pick the state. So Genius preserves that to some extent, but not with large issuers, as you mentioned, right? So if under 10 billion, you have the option to choose state or federal, and then above 10 billion, you have to have a federal charter. And that could be from a stablecoin specific charters from the OCC, or that could be just a general bank charter. But the intention in the legislation, and they do ask about this also in the ANPR, is for a consistent standard that exists across jurisdictions, so that the states, that if you get a charter from a state, it has to be compliant with Genius. That's another aspect, I guess, of sort of Genius compliant. Yeah, so that's one of that's what they're going to figure out, is like, how do they decide? How does the federal government decide? Okay, the state of XYZ, their regulatory regime is good enough, right? It's similar enough to the federal standard. So that they ask about that, like, what should the process be? Who gets to decide that? And
because
no, I think in theory it should be like the supervision, all that. I mean, like in theory it should be. The idea is that it's going to be the same no matter where you go.
Right.
In practice, I'm sure there's going to be some nuance, and one of the benefits of going to a state is sometimes you get more attention. The states are a little bit closer to the ground, and it may be the same robust standard, but you may have people you can call, so to speak, right, and kind of get more attention, right? But we'll see. We'll see. There's a lot of nuance in that too.
Yeah. Well, I mean, it's interesting in that stablecoins are obviously like they're internet money. The internet is global. Stablecoins are global. Can everyone get state licensed in the easiest state and operate everywhere? That seems like a very easy workaround to any other sort of more robust regulatory regime. I mean, in traditional banking, like you're probably doing most of your business in your local state, right? Where you're incorporated, where you're operated, where you're regulated. There's literally nothing to prevent all of the usage of your stablecoin from happening elsewhere.
Yeah, look, I think that is the idea, that you can sort of you can operate anywhere because it's a similar standard, and I think states will compete, right, to offer probably. Everyone's going to have to, again, sort of be. The intention I know is to kind of have a consistent standard, but I do think you'll have some competition around service standards, right? Meaning, like, I mean, I'll give you a specific example, right? So say you get approval to issue a stable coin. Is that approval to issue it on any chain you want, or do you have to go back to the regulator each time you want to add a new chain? And how quickly is that process going to be, right? And you could see regulators competing on service quality, right? Where they're saying, like, look, well, if you will make decisions, quickly for you, or things of that nature. So even if the standards are the same, there may be some benefits, right, depending on which jurisdictions can move quickly and keep pace with the business.
How have you seen, the sort of, I guess seed stage, if that's your exclusive focus, maybe clarify for us what your investment stage focus is. But how have you seen the market at the early stage change in response to Genius?
Yeah, so that is the stage. You're focused on pre-seed and seed out of Fund 1, and Fund 2 will be a similar. Yeah, look, it's very crowded. I mean, it's very crowded. I kind of organized the stablecoin stack into 3 components. I mean, you've got issuance, you've got kind of infrastructure orchestration, and you have apps, right? The issuance layer, I think, is sort of not really a startup opportunity for the most part. There will be some exceptions, but I think generally, like, you have to have a lot of scale, distribution to get, at least for a US dollar stablecoin. And then the infrastructure layer is crowded, right? I mean, everyone wants to kind of own the pipes. The app layer is probably the most open, but also I think the area where there's maybe the least amount of defensibility, right? I mean, it's sort of relatively easy, I think, to start up a stablecoin neobank. And there's 2 sides of the coin, right? I mean, one side, the founders that are coming in are just incredible. I mean, just really strong founders like yourself, of course, like that are just like, really
company notwithstanding, right?
no, especially. But no, I mean, like, in all truth, in all seriousness, I mean, like, really strong founders that are coming from other parts of the financial system, and they see a big opportunity in stablecoin. The flip side of it is it's getting very crowded, right? So there's it's getting much harder. I think it'll be much harder to win. Valuation expectations are, you can still find actually reasonable investment opportunities, but they're whatever. It's kind of all over the map, actually. Mm-hmm. So it's, I think stablecoins are going to be this very long time. I mean, it's like, if you look at the numbers, I mean, it's still pretty small. It's a percent of like money supply. And I think it's a really long-term secular trend that, I'll be investing in for, at least another decade. But, what it takes to win is the bar is going up, right? And so I think like the founder selection, for me anyway, I mean, the bar is very high.
Mm. So maybe to wrap up, I appreciate that I'm digging up ancient history in crypto terms at this point, but in must have been May at this point, you organized an incredible, effectively closed door symposium with executives, operators in the stablecoin space. I think there was a pretty strong representation from incumbent firms. I'm intentional not to overshare too many details. I'm sure it was Chatham House rules at the very least, but I'll let you fill in whatever you want to. But regardless, I mean, in that venue, I mean, we're hearing from some of the largest banks, payment companies, e-commerce firms, with respect to the broader kind of stablecoin opportunity. How do you're still an operating partner at Nyca. You're interacting with that, bank LP set, the limited partner advisors who you mentioned, I think are in many cases incredibly seasoned, former banking or TradFi executives. How do you see that part of the market positioning with respect to stablecoins at this point?
Yeah, no, it's a great, and I'm glad you're able to join that, and we can keep all the alpha to your paid subscription version of it. No, look, I was good. I think here's where I think things stand. I think everyone realized. So who was in the room, right? The room was crypto founders such as yourself as well, and then like corporate treasurers, right? Those were kind of the two main audiences. And I think the question was, what are the potential benefits for stablecoins for corporate treasurers, and what will it take for corporate treasurers to use it? I think that a couple of things were clear. Is that one is that everyone showed up, right? I mean, like you can't ignore it, right? Like maybe a year ago you just wouldn't send someone, right? Like now you got to send someone, right? I mean, it's like a serious topic you can't ignore. I do think there's still some level. Again, we're not revealing names of anyone or organizations, but I do think there's some people who are hoping they can ignore it, right? One kind of maybe counterintuitive conclusion for me coming out of it was that I think the big legacy companies, the companies that have been around for 100 years, 150 years, they know they got to like do things different, right? I mean, like it's like very clear, right, to them. Now, their agility, their ability to quickly is a different matter, but sort of like they know, right? They know that they've got to innovate or die, so to speak. I think it's the companies that are maybe 10, 15 years old, 20 years old, kind of the fintech 1.0 payments companies who maybe don't feel the heat as much, right? And they're kind of thinking, look, we got great tech, right? Our tech's amazing. And look, maybe it probably still is to some extent, right? But counterintuitively, I felt like coming out of it, they probably were, the most resistant or the least excited, I guess, right, about this transformation than the people, than kind of the dinosaurs. But I think that was one. I think another is that there's still a long way to go, right, for stablecoins to be useful to corporate treasurers. And there are a number of different kind of things. I mean, privacy is one, right? Are you going to really do payments? You're going to really make payments at scale if like everyone can know your vendors and your supplier, like your customers, right? So there are some but I think all these things can sort of be solved, right? The other thing was about yield, of course, right? And I think one of the there's just a huge opportunity, I think, to create greater fungibility between kind of the yield bearing assets and the non yield bearing assets, which is something I know that multi-liquid is already leading in terms of developing kind of the next generation of solutions there. But I think that category is going to be really important for corporate treasurer adoption, right? The ability to move seamlessly between different forms of cash and cash equivalents, and in a way that's programmatic, or that can be programmed and automated and all of that to maximize kind of yield generation while also maximizing other objectives, right? Which would include sort of holding your assets in safe, keeping your money in safe assets, kind of being, limiting your risk. I mean, I think someone made the comment there, right, that corporate treasury, where there's almost zero tolerance for failure, right? I mean, you can't lose money, right? And so there's a lot of opportunity, but a long way to go, and a big opportunity though for founders and startups in that category.
Yeah, I think the one additional point that I took away very very clearly from that venue, which kind of surprised me because I guess don't work in the stablecoin payment space per se on a day-to-day basis, but stablecoins are not always the cheapest payment option, especially when it comes to larger firms with kind of comprehensive like relationship style banking relationships with various like kind of traditional as well as fintech payment solutions at their disposal. They can either get subsidized pricing or at the very least in very liquid markets, like pricing can be quite tight on payments and FX. So that I thought was interesting, right? Because it's easy to just simplistically assume, well, stablecoin payments on an L2 are free, So there, and I don't know, it cost me $25 to send a wire, or 3% for a card transaction. So stablecoins are obviously better, but I think very very simplistic reasoning there. However, the instant settlement nature, I mean, literally, stablecoins are magic compared to any other payments, at least in the US. Instant payments, instant settlement, zero counterparty risk. It is magic. And I think we have to expect that sort of experience differential to really ultimately drive adoption. I think price will work itself out. I know we're coming up on time, but it's been a really great conversation. I appreciate you taking the time to connect today.
Yeah, good to see you, Will. Take care.
All right. Matt Homer, thank you very much for joining us today.